The G20 meeting of finance ministers and central bank governors has wrapped up here in Shanghai, with policymakers returning home with their hands full of tasks to calm financial markets and lift growth. In an exclusive conversation with the Bank of England Governor Mark Carney, he tells me his view about how to contain global market volatility. Governor Carney, the G20 finance ministers and central bank governors have been meeting here in Shanghai. What were the key outcomes?
Well, we're just getting started. It's a very ambitious agenda. I think I'd take three things from this meeting. The first is, in terms of the macroeconomic situation, policy response, real emphasis on using all levers of policy as much as possible. Monetary policy has to continue to be accommodative. If you have fiscal space, and not everyone does, but if you have it, use it effectively, and then the importance of structural policies. And I think the Chinese leadership is really raising the bar for that. More emphasis on peer review, indicators, and actual progress, not process. Second issue I'd raise, financial reform. We'll get a chance to talk about it. And then thirdly, green finance. Hugely important here, hugely important globally. Progress both in terms of how we can develop a cross-border green bond market and how we can improve disclosure for corporations.
China's economic slowdown, the stock market volatility and the yuan depreciation are worrying international investors. What is the BOE's view on China's economic outlook?
Well, I think we have a very constructive view on the Chinese economy. I wouldn't necessarily term it as a slowdown. It's a series of transitions. Transitions, as you well know, from external demand to more domestically focused, from export to consumer, from manufacturing to services, all those transitions underway. And we see real progress being made on all of those. Now, anytime you have transitions of those scales, even one of them, you're going to have some volatility. It's understandable. And then as well, something we did talk about over the last few days, on the financial side, on the capital account side, the adjustments to currency policy, very sensible in my view, but also the capital account opening for inbound foreign institutional flows into the bond market, which I think is a very exciting development.
You also serve as the chair of the Financial Stability Board. Given the ongoing market volatility, what kind of urgent measures need to be taken in order to stabilize the financial system?
Well, I think the first thing has been done, which is to reinforce the resilience of the core of the banking system. The dog that didn't bark, if you will, during the last few months has been distress at the core of the system. And that's because over $800 billion of equity capital has been built in these institutions, in the world's largest banks, in addition to the $560 billion of capital put into the core of the Chinese banks that they've built up over that period of time. So the core is strong. The pressure on those bank shares, I would suggest, is more about their returns as opposed to their resilience, so their business models. That's the first thing, so we've done that. We need to finish the job on other reforms that we've agreed. And then the other thing we need to do, and we are doing, is to look at how cross-border flows are changing. They're much more based in the asset management industry as opposed to through the banks. And it's about how that industry and how those markets manage liquidity. This is a very positive development, but it's probably one that needs to mature a bit. There are likely some things that we can do, and as the G20 and under China's presidency, I think we'll take some decisions in that regard.
The UK is set to have a referendum in June on whether or not to remain in the European Union. A Brexit would pose significant risks in terms of current account deficit, which currently stands at 3.7% of GDP. What kind of measures would need to be taken to protect the financial system if Britain opts to leave the EU?
Obviously, do contingency planning for a variety of events, possible events. That would be one of them. The best thing, or the best way to conduct contingency planning is not to go into great detail around them, so we're taking our responsibility seriously. There are a variety of issues that will be considered for the British people, and we'll leave the decision to them.
You reiterated in February that the conditions for Britain are not in place yet to hike interest rates, even after almost 7 years of a record low 0.5%. Under which conditions would you consider an interest rate hike?
We're pretty clear that we need to see a few things happen in order for rate hikes to be consistent with achieving our 2% inflation target and keeping there. First, we need to see the economy growing and it's faster than its potential rate of growth. So think 0.5, 0.6 type percentage points per quarter. Secondly, we need to see unit labor costs begin to build a little further. And thirdly, we need to see core inflation start to pick up. Now, there's a variety of indicators of all those factors. We take them all into account. We'd also take into account the global situation, changes in financial conditions, in taking any decision. But it's all from the lens of achieving that inflation target, and we'll take it one decision at a time, and we won't be tied to any preset timetable.